Hello and welcome to Brandtuned, Successful Brand, Successful Business, the show for entrepreneurs and brand creators where we discuss personal and business branding to give you ideas and inspiration for your own brand. I'm Shireen Smith, lawyer, entrepreneur, author, and advocate for developing purpose-based brands to change the world. David B. Horne qualified as a chartered accountant with Pricewaterhouse in 1987 and moved into in-house finance roles for blue-chip companies, including a 10-year stint as CFO with some very fast-growing companies when he raised over £100 million and bought or sold more than 20 businesses. This experience resulted in his Add, Then Multiply methodology for helping founders to scale massively by raising funds and investing in their businesses. He's put it all into a book of that name, which recently won a Business Book Award in its category. So welcome, David, to the Brandtuned podcast.
Thank you, Shireen. Nice to be here.
What does the B in your name stand for, as a matter of interest?
Bowen. It was my father's mother's maiden name.
Ah, right. And are you actually more difficult to find on Google as David Horne without the B?
There are several other David Hornes that are also on Google. One of them is the chief executive of, I think it's now LNER, used to be Virgin Railways. One of them, actually, the interesting thing came when I was doing my research before my book went on to Amazon, and there is another David Horne on Amazon who publishes, quite prolifically publishes gay novels.
Oh, what a nuisance for you.
So I thought I'll just throw the B in there to have something different.
Yeah, that's a good idea. You want to stand out, obviously, when people put your name in. So, David, what is your methodology for supporting businesses to scale, and what type of business is it most suited to?
So, methodology is called FACE, which stands for Fund, Acquire, Consolidate, and Exit. So basically, fund is raising money, acquire is buying other companies, consolidate is putting them together, and exit is ultimately selling your business so that you can go on and do whatever the next stage of your life holds for you. And in terms of who is it relevant for, I mean, really, it's relevant for most established SMEs. It's probably less relevant for startups and things. So really, my kind of target client, it doesn't depend on any particular industry, but target client would be a fairly established business with at least £2 million in turnover, so that they've got sufficient size and scale to have a reasonable valuation, so that when they raise money, they don't end up being diluted down too much. But that enables them to raise enough that they can go out and make some attractive acquisitions and, kind of, I guess in layman's terms, the way I often position this is, you could own 100% of your business, which is like owning 100% of a pie that's worth a couple of million, or you could raise capital and be diluted down and own 50% of a business, but because of the scale up that you've done, it's now worth 20 million. So you've got the option of owning 100% of 2 million or 50% of 20 million. And, it's a choice. Some people want to maintain 100%, and that's absolutely fine. But for those who are not totally tied to the idea that they have to have complete control, it's a great way to scale up a business quickly. And I mean, I have a case study in the book of an entrepreneur that I worked with for 3 years. When I joined his business, turnover was 1.1 million. Profits were about 400 grand. 3 years later, we had made 7 acquisitions. Turnover was 28 million and profits were 4.5 million. We were operating in 3 different countries. So that's 25x growth in revenue in 3 years. You can't do that with organic growth.
Wow, that is something. So how do you actually help them? Are you coaching them or do you work in their businesses? How does it work?
A combination of the two, really. So I'm in the process of, I was until COVID-19 hit, in the process of developing a mastermind program that I was going to run to open this up to a wider range of people. And that would be a sort of a coaching and a training thing. But in addition to that, I do work directly with the founders. So in the last 12 months, I've worked on 2 exits, both of which have been pulled because of COVID. And I'm currently working on a substantial fundraising for a client in Switzerland, which we're still working on, and we're still hopeful that we'll be able to get it away. But it's an interesting time, so we'll see where it goes.
Right. So very interesting. So do you think it's going to become more difficult to raise funds during a recession?
Yes and no. Yes, it's going to be more difficult because valuations are going to be under pressure. Because it's always tricky to assess the valuation of a privately held business. But if you're in an industry that has some publicly traded comparable businesses, you can use that as a benchmark for, looking at what's an appropriate earnings multiple that you could use on the business, or any other multiple that you might choose to use. And on the basis that, there's a publicly traded company doing something similar, then you could make the argument that that's a fair valuation. And I mean, stock markets around the world have they've fallen off 20, 30%. So valuations are going to come under pressure. There's no question. But actually raising capital, the investors still have the money. They have it in their books. They have it on their balance sheets. Some of them have specifically said they're going to wait until COVID-19 is over, or at least until the lockdown is over, before they make any investments. But I'm aware of a number of investors that are still actively looking at deals. So, it's going to be a little harder. It'll be a little bit longer. Valuations won't be as high, but the money's still out there, and for the right business, it can be raised.
Okay. I was interested that you think that your mastermind wouldn't be viable anymore. What impact will the coronavirus epidemic have on the vision that you have for your business?
That's a good question. I guess in my head, I had the mastermind being an in-person program. Could it run online? I mean, we're finding out that a lot of things can run online. I still like the idea of people coming together and being together physically. And for anyone who's been through a really successful mastermind program, it's quite an intense personal experience. And I mean, I'm not saying that it's now not going to happen because of COVID-19, but I think it'll be delayed. But yeah, who knows? Maybe I should put some feelers out and see if people are interested in starting something on an online basis and take it from there. I still would like it to be an in-person event at some point, because I feel that you get more. You can do lots and you can communicate lots online, but you get more from being face to face in the same room with people.
Yeah, absolutely. But a combination of the two might work quite well.
100%. And in fact, the original plan had been to run a 2-day event every other month and to do a series of Zoom calls in the month that we weren't meeting.
Right.
So maybe I just need to rethink it, and maybe the first few meetings will just be done on Zoom. There'll be more preparatory stuff.
Yeah, I mean, it's a great time at the moment for people to rethink their vision, mission, values, and, prepare for the change in the economy, which will happen eventually, I guess, mid-2021.
Hopefully.
Hopefully, yes. So, David, how did you come up with the name Add, Then Multiply?
So I first launched my my consulting business, and it was originally called Bowen Business Consultants. So your question about the B in my middle name was relevant there. And then when I started thinking about focusing more on what I do in terms of the expansion and growth and advising, and I have a very good friend who is a branding expert. He used to do a lot of work with some of the big global branding agencies and works for himself now. And I invited him to lunch, and we were just chatting, and I was saying, look, I'm thinking of doing something different with the brand and the name of the company, and this is where I'm looking at taking the business. Can we explore options? And he came back to me with a whole bunch of different ideas, and one of them was actually, interestingly, he said drop the business consultants and just call the company Bowen. And then I'd had an old logo that was an 8-pointed star that was literally a plus sign and a multiplication sign, one on top of the other.
Mm-hmm.
And he said he really liked that, but he said, why don't we go with Bowen, and then the strap line, add then multiply. And I just looked at it and I thought, add then multiply, that's it, that's the one. And I changed the name of the company, and we've been trading as add then multiply ever since.
Yeah, it really explains what you're all about, doesn't it?
It does.
The way you work.
It
yes.
does. Much more than Bowen Business Consultants did.
Yeah. So did you do any further work with him on your brand?
He designed the cover of my book.
Mm-hmm.
And whenever I'm working with clients that need any branding advice, I bring him in.
Right. So have you actually formally gone through a process to develop your own brand strategy or vision, mission, values, and so on, or not?
Yes, but it's not documented, and I probably should take some time while we're on this lockdown to actually document it. Yes, we've been through the process. We've got a written brand guidelines. But yeah, the vision, mission, values, and it's interesting in my book. One of the things that I talk to clients about, to people about as one of the preparatory steps, is to make sure you've got real clarity over your vision and culture and values. So I guess it would help if I did. It's one of those the cobbler's children kind of examples.
Yes. We'll take a short break at this point, as I'd like to mention the brand-tuned series of webinars which support founders to think through their brand, taking IP into account at the right time, which is before you make firm decisions about what to create. Just visit brandtuned.com and the webinars are referenced right there on the homepage. Okay, back to the podcast now. So I'm just trying to look up your logo, because I just wrote an article today about visual hammers. Yeah, so you've got quite a good one. That could be a visual hammer. You've got the plus and the multiply with a star in the middle.
Yeah.
Yeah, that's really excellent, because it conveys exactly what your name is. I really like your brand.
Thank you.
When you merge two cultures, like when you acquire a business, I imagine it must be quite difficult to blend two cultures which have totally different, purposes, visions, missions, and so on, to bring them together.
Definitely.
Can you give us an insight into the challenges and how you dealt with a particular case?
Sure. Gosh, I could give you a few, and it's interesting. This is the consolidate stage of my FACE methodology, and as I say in the book, this is the area where get this right and you can make a real success of the deal. Get it wrong, and this is where the deal can go horribly wrong. My first adult experience of M&A was early in my career after I'd left Pricewaterhouse. My biggest client was a company called NCR, and they made me a very attractive offer to join them, so I took it. And about 2 years into that, NCR was subject of a hostile takeover bid from AT&T, the US telecoms business. And in the 90s, it was identified as one of the worst ever value-destroying M&A transactions, until we had the excesses of the dot-com boom. The change in culture is huge. I was a middle level manager in a huge company at the time, so I wasn't really involved in the detail. But when I fast forward to my roles in PLC days, I'll tell you about my second PLC, which was a company that did online auctions, and we got wind that our largest global competitor was up for sale, and so we went out and raised 28 million and bought them and did a global integration. We were in 16 countries, they were in about a dozen, and there wasn't that much overlap. So we ended up being in 23 countries. There were 3 countries, the UK, the USA, and Germany, where there was a significant overlap, and we ripped out a lot of costs and did a huge, restructuring. And it's really a case of you need to sit down and really plan out in detail what are the steps you're going to take. So one of the commitments we had when we did the fundraising was that we were going to rip £5 million of cost out of the combined entity. And as the CFO of that group, it was my job to track those savings. So we had to sit down and go through with all of the regional heads. And, when you're ripping out that kind of money, it's mainly people. And so I had a great big spreadsheet of, all of the different people that we had said we were going to take out and what it was costing and all that. And, you deal with that. And then when you've got in the countries where we had the big overlaps, not only did we have the challenge of ripping out a lot of costs, but we also had the challenge of trying to put the cultures together. Yeah, there were some differences. We worked hard to make sure that on the top executive team, there were members of both companies. So, I mean, in the top exec group, there were, 8 people? And I think 5 of them were from the acquiring company and 3 of them were from the acquired company. And that gave us an opportunity because it meant that the people in the acquired company felt that they had a representation. On the other hand, we had some challenges with 1 or 2 of those people who were very resistant to some of the change that we were looking at doing. I'll use another example from my first PLC, which was a digital media and publishing business, and we actually had a very clearly set out strategy. We would not keep former owners in the business. So if we bought the business from a former owner who had whatever role in the company, their role ended at the completion of the deal. We would ask them to stick around for a handover period. And we used to put them on something called the senior advisory board. But the senior advisory board had no mandate and never met officially. But it was a way to let the people understand, for them to walk away and feel that they still had some value and stuff, and that was important. But therefore, because it was wholly under our management, we were able to make some of the cultural changes that we wanted to in order to drive the business forward and really to look at what are the changes that we want to make, what are the investments that we want to make to develop and grow the business. At the end of the day, Shireen, it's all about people, and you need to understand the different motivations that people have, and you need to understand how to get people to get on board with new initiatives. And sometimes you have to make some tough decisions, and there are sometimes people who are casualties in the process because they wouldn't or couldn't adapt to whatever the new environment was.
Do you actually consider whether the cultures can be blended together before you buy as a company?
Oh, that's a good one. We usually look at how complementary the businesses are. In my first PLC, we had a political division that was very well established. It was a brand that had been around for nearly 200 years. And then we bought the new kid on the block in the industry, which was only about 10 years old, but was a really fast-driving, hard-charging, sales-driven organization, culturally very, very different. And what was really interesting was that new organization, they came up against us as the competition all the time because we were the established name. And we actually reached a decision together with the leaders of that business that we would rebrand and they would drop their names and adopt ours because it had much greater brand value in the marketplace. But we also allowed them to, we softened down some of their hard charging sales activities, but that political division became a much more sales driven organization than it had been before. So we actually took aspects of both cultures. And I think, as with anything, when you're putting bits and pieces together, it's good that you can find good things from both.
Yeah, it is. Do you ever go through a rebranding exercise in order to bring the two businesses together more and unify them?
Yes, so we did that with the political division in that company. So we dropped where they had publications that had brand recognition, we left the names of those publications intact, but we changed so when their people rang up, so our established brand was called was called Dodds, and theirs was called Parliamentary Communications. And they were more than happy to just drop Parliamentary Communications I think there was a transition period of 6 months where we called them Dodds Parliamentary Communications. And then after 6 months, they were very happy to just drop the Parliamentary Communications and use Dodds because it was such a well-recognized brand.
I imagine it must just be so difficult because even for a company to make sure that all the different divisions make decisions on brand takes quite a lot of training and communicating. And then when you lose knowledge because people leave, you have to keep that alive somehow.
I mean, keeping people on board is one of the key things. And again, I'll go back to the auction business. So there, the world headquarters of the company that we bought was in LA, and our North American headquarters were in Baltimore on the East Coast, and so all of their group finance people were based out of LA, and we knew from the due diligence that their finances needed a significant overhaul. But equally, I was very concerned that I didn't want to just fire everybody in LA and try and pick up and go. And I was absolutely thrilled when I managed to convince one of their mid-level managers in their finance team to relocate to Baltimore. So we actually had some institutional knowledge.
Mm-hmm.
And I go into that in more detail in the book. There's actually a little side panel on institutional knowledge because it's a really important thing to remember when you're running a business. And it's just, the things that people understand and know instinctively from day to day, and the funny little anomalies that happened a year ago that nobody remembers. And I had that earlier in my career. When I was working in a very acquisitive PR agency group, and we got taken over and merged into a much, much larger business. And my role was made redundant because they already had a European CFO, and they were bigger, and they made the acquisition, and that's kind of life. But it was interesting because they made both me and my boss in the UK redundant, and we had done 7 acquisitions in 2 years. And it was about 6 or 7 months before I got the first phone call to come back because nobody understood the details on the deals and there were disputes. And then it came to year end and the auditors were asking questions and nobody knew the answers. And I ended up doing rather a lot of consulting work for them. And I've seen that happen so many times. So doing something to protect institutional knowledge and having representation of both sides of the business involved in the process is really, really important.
Great. So how important is IP and brand to the value of the businesses that you've acquired?
Oh, it's key. I mean, in the broader sense of IP and brand, not just the name and the logo, but the whole way of doing business, the whole ethos, what the brand stands for. And again, if I take the example of the political publishing one, here was a new aggressive startup business doing quite well. All of a sudden, they had the opportunity to carry on doing what they were doing, but instead of the sort of the Ford XR4 brand, they now had the Rolls-Royce brand. So from that perspective, that was a great move, and those kinds of things are really beneficial. I think as well, again, from the publishing side, the protection of IP is absolutely critical because we were buying rights. I mean, there weren't really physical assets that we were buying. We were buying publishing rights and the rights to the ownership of titles, whether it was books or magazines or websites or events and all of that. So the IP was absolutely critical.
Yeah. I mean, sometimes I come across people who say that they're not really bothered by their name because they think they're going to be acquired and whoever acquires them won't want to use the same name. But it's still the value of the business accumulates round the name. And so, the acquirer can change the name, but they'll just redirect any traffic to that website. It doesn't matter that they're going to change the name. You still need to be able to be distinctive before you get acquired.
Absolutely. And not worrying about your name on the basis that you might get acquired. Well, what if you don't get acquired and you end up with a rubbish name?
Yes. So have you actually ever increased or reduced the amount you were paying for a business based on what you discovered during due diligence?
Yes, absolutely. The auction business, so the deal was valued at 28 million US, and the initial purchase price was 31 million US. And we found a number of things in due diligence that led to a $3 million purchase price adjustment.
Can you reveal any particular deficiency that?
Yeah, so they had told us that certain types of things were no longer happening, and we discovered in due diligence that those things were happening, and we held an escrow reserve on the portion of the purchase that was relevant to that particular transaction. So it was an auction business, and normally in the auction business you buy and sell on commission. So you act as effectively as the agent. So you have a buyer and you have a seller, and you act as the party who's in between. But every now and then, some auction houses do what's called principal business, where they actually buy the ownership of the assets from whoever was selling them, carry that risk on their own book, and then sell them. And this particular company had a couple of principal transactions that had gone bad. And we discovered that during the due diligence, and we had been assured during the negotiation process that they didn't have any material principal transactions. And we discovered two of them, and put $3 million that were valued at $3 million, and we put $3 million into an escrow account. And sure enough, those assets didn't sell, and we took the money back out of escrow, and it was effectively a purchase price adjustment.
That's interesting.
It was a very, very difficult negotiation, but we did do it.
Interesting. So which brand in your industry, David, do you particularly admire, and why? Which industry would you categorize as yours, actually?
Oh, which industry do I categorize as mine? Early on in my career, I read a wonderful book called Become a Category of One. And I like to think that I am in some ways. I mean,
you are very distinctive in what you do.
There are other corporate finance houses. There are other boutique consultancy firms. I mean, if I wanted to pick a name that most people are going to recognize, I'd pick PwC, partly because I'm an alumnus of the firm. And I still have very good contacts there. In fact, I've done a number of things with PwC where we've been involved in partnering together. I met a recently appointed partner a few months ago and was talking with her about what I do and what areas I'm in, and she said, well, one thing that might be really interesting is you bring clients along. You start with the clients when they're worth, let's say, 2 million, and then they get up to worth 25, 30, 50 million, and then they're going to need a broader range of services that you can't offer. Maybe you can just funnel them into us, and I'd be delighted to be able to say to my clients, well, work with me and grow with me, and then we'll get you into it to becoming a PwC client. So yeah, I'll say PwC is a brand that I admire.
Well, that's lovely that you qualified there and they're a brand that you admire.
Yeah.
So thank you very much, David, for this interview. We'll be sure to add mention of your book in the show notes.
Thank you.
Great. So thank you.
Wonderful.
Bye-bye.
My pleasure.
That's it for this week. Do subscribe to the brandtuned newsletter to get weekly updates. I'd also love to get your feedback. Just send me an email to info@brandtuned.com. Finally, if you liked the episode, please do share it with your friends and colleagues and review it on iTunes or whichever platform you use to listen to podcasts. If you leave us a 5-star review, it means more people will listen and we can spread the word much more quickly about the podcast. Thank you and bye for now.